Good morning. My name is David Weiskopf, and I would like to call to order the Length of Service Awards Program, otherwise known as LOSAP, committee meeting on February the 11th, 2022 at 9:30 a.m. here in the Chesapeake Building, and I'll do a roll call starting at my far left.
Jeanette Cudmore, CFO.
Mike Hewitt, County Commissioner.
David Weiskopf, County Attorney.
John Walters, Citizen Representative.
Catherine Pratzen, Director of Human Resources.
Thank you, everyone. Next, we'll do the approval of the February 11th agenda.
I move to approve the agenda February 11th.
I'll second.
Thank you. I have a first and a second. All in favor, please say aye.
Aye.
Any opposed? Ayes have it. Next would be the approval of the December 3rd, 2021 meeting minutes. Do I have a motion?
Well, you usually take a second to read them, but I read them last night, so I'm not sure if anybody else read them.
Well,
I'll make a motion to
Mr.
approve.
Waters and myself were not here, so we'll rely on the others.
Okay, I'll make a motion to approve the minutes from December 3rd, 2021.
Thank you.
I'll second.
Thank you. I have a first and a second. All in favor?
Aye.
Thank you. All
I abstain.
abstaining? Two of us. Ayes have it. Motion carries. Thank you. Next will be old business, LOSAP benefits, internal audit of points list, and the current process, which will be presented by Paula Turner. I don't know if you had any opening remarks.
I do, yes, thank you, thank you.
had a few too.
And just in follow-up to our December meeting, we have discussed a couple times last year a request from the volunteers to increase their benefits. And in December, we talked about proposal from S&B Company, and they are the county's auditors, where they would review the certification lists and ensure that processes were followed. The board approved that proposal. I wanted to clarify my remarks in December. I understood the process at that time incorrectly, that every year the volunteers submit a certification list, the commissioners approve it. I mistakenly presented that that list would be held up for the S&B analysis, and that's not accurate. The list would be certified as normal process by the commissioners, and then S&B would do their work throughout the course of the year. So I wanted to clarify that. In addition to that, Paula Turner, who is a representative from the LOSAP Executive Committee who goes over those lists and certifies them in advance of the commissioners, is here to describe their internal process. And then, you know, the board would have the opportunity to determine whether we still want to go forward with S&B or if we're satisfied with the internal process as it currently exists.
And when we talk about certifying, what we're certifying is the number of hours a volunteer has done throughout the year, correct?
Yes, and then that certification, those points would then determine the benefit that a volunteer would receive, the pension benefit.
Okay, and I'm sorry, Commissioner, you had something?
No, real quick, I want to say, John Walters, thank you for coming on our board. You have some big shoes to fill. Marianne Murray was an excellent citizen rep, and I'm sure you'll be the same.
I'll do my best.
You and I have known each other for a long, long time, and I think you'll be a good addition.
Thank you
So
for the
welcome aboard. We've had these meetings discussing the LOSAP points, and we all understand that the LOSAP points kind of reward our volunteers for their service to the county. Now, if I hear the word again, I'm going to get really flip out, is COVID-19. That fouled up a lot of things over the past couple of years. And what kind of brought this thing to a head, in my opinion, was that we had people who were emailing, or if they responded to an email or they got an email, they got credit for points. We also had a situation where a lot of volunteers had stopped responding, stopped coming in. It forced the county to shift from a pretty much volunteer force to now we're going with career. We're going with paid people to do these jobs. So part of it got to be is we know this is an expensive, this LOSAP's an expensive expense to the county. It runs about $1 million a year maybe plus or minus a couple $100,000. The point of the matter is we need to make sure that we have accountability to the taxpayers of St. Mary's County. And while this commissioner, and I don't think anybody on this board, thinks the process is being abused, we did determine we needed to understand it better. And that led to the idea of doing an audit. So naturally, we have auditors that work for the county, work for the Board of Ed, work for Metcom, S&B company, and we thought, hey, they'd be a good one to do, to have that happen. Well, Paula Turner, amazing lady, I know her family, wonderful people, and they've been involved in this volunteer thing for years and years. And she reached out to me and said, Mike, I watched the meeting, actually the commissioner meeting, and I had some questions, and so we talked for a bit. And she started enlightening me on the process. So I said, look, can you come to this board and explain to us the internal process that's used now? Because the S&B audit group could be $10,000, $20,000 investment by the county. And I'm not sure they would uncover probably what we think they should uncover. It may be a cursory kind of thing, and I'm very sensitive to spending taxpayer money and finding out stuff I already know. So with that said, I think Paula can give us some insights into how it works, and that this board can decide whether or not they want to use S&B.
Right.
So my first question here is, have we engaged S&B yet?
Just in discussions, no payments, no contracts.
No
nothing-
contract.
No,
Right.
nothing has been signed.
Okay, so you haven't spent any money with them?
Not yet.
Not a dime.
Thank you.
Thank you, sir. Ms. Turner, thank you so much for being here today.
And Paula provided some screenshots as examples of some of the work that she looks at. They're copied in your manual, and then Michelle is also going to broadcast them on the screens, if that's helpful.
Thanks so much for having me here to explain this. Just a little bit of background. This program, the LoSAP program, I'm sure you all know, started in 1980. And at that time, there
Can you
was
pull the microphone just so people can hear you? Thank
there
you.
was a set of guidelines set up by the original, I guess, LoSAP Executive Board. We still use those guidelines today, so we're still following the procedures, doing it exactly how it was set up. Every company coordinator has a copy of those guidelines. Within those guidelines, there's a list of LoSAP audit questions, which we go over every January at our audit meetings with every individual company. With that being said, we met with a few people from the LoSAP Executive Board in 2018 with similar concerns about the consistency across the companies and how they're adding their points and things like that. A follow-up meeting was set up with a company called Firehouse Solutions because they have a really great program. Once we finished that meeting and people had time to look at that, every company in the county now has a website that is set up through Firehouse Solutions. Within that website are LoSAP tools, which they, with our help, they've developed, and the companies are consistent across the board using these tools. If you look at the slides, this first one that's up, this is just a first page of a website. When you go, this is 7th District Volunteer Rescue Squad. If you look down that left-hand column, you can see there's a LoSAP records, LoSAP reports. If you were to say select on the alarms, that takes you to the second page, the next slide. Under those alarms, they come in by date. You can select one of those alarms, and once you click on that, that tells you who were on the calls, what members were on those calls. So great for tracking each member's calls. The next slide shows meetings. If they set this up with their company meetings, and you can see, this is, Hattie Norris sent this to me. She's one of the members of the executive board and runs a lot, great volunteer. So you can see she's already, within the month of January this year, she's already had a number of meetings that she's attended, but they keep track of all these meetings. We selected the January 10th business meeting. If you look at that one, next slide, please.
May I ask Paula a quick question? Is this the account of an individual, or is this of the company?
This one right here is the account of Hattie.
So this is what she herself has done. Okay.
But when you do select, if you select that meeting, I selected the January 10th meeting, takes you to this page here, you can look at that, and it shows you every person in attendance at that meeting.
Oh, okay.
And this would be put in, when you attend a meeting, roster set up, everyone, signs the roster, it's recorded. Either the secretary or whoever's in charge of that would add the personnel to the meetings on the LoSAP tool.
And so does this, like, attending a meeting gives you a point or what?
Yes.
And so does that immediately go to some other chart that
Yes, it
tracks the
does.
points? I'm sorry to
Nope.
get ahead of you.
It certainly does. Nope. So, and we have a set list of categories that was set up by the commissioners when this LoSAP program was set up. We get points for meetings, drills, training, collateral hours, and alarms. So, and there's caps to each category. You have to get points in at least 2 categories to qualify for LoSAP, just to make sure you're, doing multiple things.
May I ask a question, please? On that same page, down the right-hand side, I see about the middle, excused. Is an excused absence like a kid going to the doctor, or you're just
Great
allowed not to be
question.
there?
So you actually have to attend the meeting to earn a LoSAP point. But companies have some other guidelines, like within our company, we may have to attend more meetings in order to be eligible to vote for officers. So you're allowed to put in, hey, I'm sick, or I have a sick kid, or I tested positive for COVID, I can't come. You can get credit by being excused to count towards your participation in the company, but not to LoSAP. And that was a great question, because the program is set up based on the county code to weed out any of the extra things that may be required by a company.
So an excused is better than a just plain absent in that column.
Exactly. It will
Thank you.
count towards something within the company, but not towards your LoSAP.
Thank you very much.
And Paula, the number of points that are, the minimum number of points that they need to earn are what, 50?
50.
50.
The maximum point category, the highest point category is for your calls, and that's 40, which is why you have to have points in multiple categories in order to earn your 50.
Okay, so you have to have at least 40 in calls.
You can have up to 40 in calls.
Gotcha.
Yeah, you can have them in any of the categories, like for instance, formal training, you can have up to 20 points. Drills, you can have up to 25. You get 25 points if you hold an elected or appointed position. Meetings, you can have up to 15 points. And our members typically go way over in all these categories. So there is another report that can be run to show all your points without capping out the categories, because I think the commissioners frequently ask, hey, over countywide, how many hours have all our volunteers run? Or how many calls throughout all companies, things like that.
Right.
So the program is set up to either cap the points at the maximum or to tell you everything everyone's earned.
So you would still need to run to get to 50 points. You would still need to go on calls.
Not necessarily, because you could hold elected position, that's 25 points. You could do collateral duties, activities around the station,
Gotcha,
things like,
gotcha.
excuse me, things like that. Yep.
Gotcha.
So it is possible without actually getting on the apparatus to earn your 50 points.
Okay.
But nobody's going to get their 50 by being unidimensional, then nothing but meetings.
Right.
Okay.
Right. Have to have 2 categories.
All right,
Yep.
thank you.
The next page shows, and this is just Hattie's activity. So, and this is for 2022. So you can see in January, she's already run 23 calls. She's got 10 collateral hours. An example of this, 1 hour equals a half a point. So this program actually tells you she had 21 hours, but collateral hours equals 10. So it does the calculations, it breaks things down to not allow you to exceed the category, without doing the calculations.
So the alarms category is the calls that are actually ran.
Yes.
Okay,
Yeah.
so she only ran calls pretty much in January.
Yep, well, this is for 2022, so.
Oh, for
Yep.
22, okay,
Yeah,
all right.
so that's, yeah.
Hasn't happened yet.
He's a little
Yeah.
behind you.
She's behind on February. She only has 1 recorded here, but
All right,
I'm sure she
thank-
has more than that by now.
I get you.
Certainly.
So, and then the second part of that, the next slide, that's the bottom of that first page there. It's telling Hattie that she's already earned her 50 points for the year. She's
In 1 month.
in 1 month, because she's that active. Not all members do. Some members, it takes them a good part of the year to get there, The reason would be is Hattie holds an elected position. So she already starts out with 25 points for the year. I mean, she has to fulfill that position for the full year to have those points.
Right.
but she's got 23 calls and numerous
So
meetings.
she doesn't
during-
have to have the 40 points in running the calls?
No, you don't have to reach the maximum in a category.
Okay,
Yeah,
just overall, you have to?
overall, yes.
I guess who inputs this? Is every member gets to input it, or?
No, this is typically through the company's input by an officer.
An
So
off-
like
and-
your secretary who takes the roster at the meetings would probably input all of the members that attended. But it's great that it's posted and members can see their activity, because if they got missed on that meeting roster, they
Certainly.
can go back, right away and
was
say, hey, I
there,
was there,
yeah.
remember, just last week.
How often is it inputted?
It's probably different across the companies. It's up to the individual companies, but I think they keep a running total so that the members
Be
can
like
see.
once a month, or?
Probably, yeah.
Okay.
So can only each member see their own, or can all members see everybody's?
Each member can see their own unless you look at the well, I think on the company activity report, you can see everybody's.
Right.
Yeah. And that's available to members with their login.
Right.
It's not open to the public to see. Yeah. The last page is, this is a good,
21.
yeah, the overall points report. This is the report that everyone would be able to see. And you can see it says on that top line there that this shows the overall points earned in each category. It does not have caps for the maximum points. So this is the report that's going to tell you, we've got,
You get a guy with 1,145 points?
right.
I mean, that's not fun.
This was for the full year
God
of
bless 'em.
2021. Yeah.
Right. We ran 336 calls, right?
Yep.
Between that and these 400 points, and goodness
Yep.
gracious.
So there are some super, super active members out there, and then there are others that fill in when they can. And,
Certainly.
this program's great because it gives everybody the opportunity. Yeah. So that is pretty much what I have. If you have other
So-
questions for me,
Oh, yeah, we got questions.
okay. Fire away.
So that gets inputted by the companies, and then you go back and check it to make sure it's accurate? What is your role?
So in January, by the third Thursday of January, all the companies have to turn in their list of eligibles to us. We take that, the executive board, Joe Ziendo from Bay District, myself, and Hattie Norris. We sit down with those reports from every company. We compare it to last year's, we look at this year's, make sure everything looks right, and then we set up audits the next week, usually the last week of January. And every member comes and meets with us, and we go down the list, ask the audit questions, which triggers them sometimes to, oh, yeah, I did have a person who was in the military. Military person can get points for 4 years. Things like that. So we do have.
So does
formal-
everyone get audited, or you just do select ones?
Every company gets audited.
Every company gets audited.
We don't audit every single individual member, but.
And so when you audit the company, you then ask the person, most likely the person that had inputted it all, various questions?
Yes. And I can send you that list of questions. It's in our LoSAP guidelines, and that's basically what we go from when we sit down and meet with them.
That would be great if you would, and then I can add it to this documentation.
Okay.
Yeah, that'd be really helpful. Thank you.
That's in that document that was created in 1980 when this program was implemented. We didn't change that.
Right, so the three of you guys that do the certification and the audit, y'all are members of the fire and rescue community?
Yes, Josie and
You're also earning points?
Yes.
And you're auditing?
Yes,
Okay, I'm
we're
just-
on, all three of us are on the list.
Right,
Yes,
okay.
Yes.
Okay.
Most of the three of us have been members for more than 25 years.
Right, okay.
May I ask a question? What kind of a thing would pop out at you that's an anomaly that you, oh, well, that's strange, that you'd look a little bit deeper?
Well, sometimes you'll have members that they maybe take a year or two off. So we kind of notice comparing the previous year's list. We go, wait, that person wasn't on the list last year. Why not? So we further investigate. We'll make notes. And as Commissioner, you've probably seen those handwritten notes that say, this person last reported with a different company with this many years. So we look back at the previous records to find out when their last year reporting was or being eligible. Those are the kind of.
People move around in the county, and they run for Lexington Park, now they run for Leonardtown, stuff like that.
Yes. Yeah. So we
Thank
track
you.
between the companies, make sure they're not reporting on two lists, make sure they're incrementing up the proper number of years of eligibility, things like that.
Okay. I have another question. With the rescue calls, right now, we had an update by Steve Walker back in, I think, this month, on the calls that have actually been made by the career. On average, 67 was done by career for regular calls, and then for ALS, it was about 86% was being handled by career. How does having career people involved with the volunteer, how does that impact the points that are earned? Are people still able to make and earn the points that need to be earned?
So the way I think that was set up, and I'm not 100% positive, is we have a member who is also a career person. He only volunteers with us. He does not get paid to come to our company. I think they put in rules where if you volunteer with a certain company, you cannot get paid with them. So we still have members that they're getting paid running calls for other companies, but when they come to our company, they're strictly volunteer.
Okay, so you haven't seen any impact of
No,
having
and they log in,
volunteers?
their calls are logged in differently. So they're being tracked in another way.
Right, but is there an impact to the volunteers that are earning points because they're not running the calls and the career individuals are now doing the majority of the calls?
No, I think it's the career people were put in, like our company, we had slots that we couldn't fill. It was daytime slots, people are working, we just couldn't get those slots filled. They reported to the county and said, I need a paid crew on this day and this day. So those are they're basically filling slots that we weren't running the calls on anyway. They were being handled by mutual aid.
So it's not impacting
Not
the
at all.
volunteers that are earning the points?
No, I don't believe it is.
Okay.
Okay, I got a few for you. Okay. Okay, you've been doing this job about 25 years, you said. How long have you been involved with EMS?
Since
with this-
1986.
1986. So that gets you in about 37 years, or 35 years.
Thank you.
Yeah, I know,
God.
thank you.
Thank God for you. Now tell me, you talked about Firehouse Solutions. Now, is that some program that's run national? Is that a software that's pretty well respected and run everywhere, or that has volunteers?
I'm not sure of their background. I know they're some local guys.
Oh, local guy.
I believe so.
So maybe there are people who have done it locally? I mean,
Yeah,
we'll
I'm
be
not
fine.
sure if they've branched out to other areas. I know one of the gentlemen that works with them is with Bay District Fire Department.
Oh, good.
But I'm not sure of the company's background.
I guess my point is that they're credible, in your opinion.
I love their website.
I got you.
I did LoSAP before there was all this, availability of the website and the tracking like that, and doing it by hand was very tedious. So I can say that this is a
Got to be
great
much
tool.
better and more consistent, I would think.
Yes.
Well, that's my next question. You talked about consistency across the companies. Is when you say everybody's using it, or most everybody's using it, some are using it, some are not using it? What's the answer?
So we had, as of the audits in January, we had 2 companies that did not use the Firehouse Solution LoSAP tools. One of those companies didn't realize that they had access to it, and we're working with them because they're super excited about doing it through that program. The other company has just been doing Excel spreadsheets, but the person that's doing it for that company has been doing it for a really long time and is very good.
Old dogs, new tricks. I'm an old dog that
Right.
has trouble with new tricks. Executive board, there's 3 of you? And that's not all from the same company, it's kind of,
Through Hattie's ALS and Company 59, I'm with Company 49, and Joe Zienda's Bay District Fire Department.
okay, so it's kind of spread out. Okay, membership numbers. What we're going to hear today is from our actuary about our contribution rates, ADC's, actuarial determined contributions. One of my concerns is that the number of volunteers. A couple years ago, I knew volunteers weren't coming back because of COVID. And once we started the vaccines and different, I thought they'd be coming back. And what we've learned is, or at least Mr. Walker has told us, is they're not coming back. So part of me wants to say if our actuarial contribution is going to be higher because of get more people retiring or more people going through, is this a bubble? Is this a group that's contracting the number of volunteers? Is it? Do we see this, like say, if it's 100 people now, is it going to be 50 people soon or in the next few years?
I'd have to really look at the numbers to tell you that.
Okay, sorry, that's a
I'm not real
tough
sure.
question. I guess my gut feeling is that number of LoSAP recipients is going to decrease.
It's decreasing.
So
I agree with you on that.
So I could be
yes.
wrong. Now, what the commissioners did recently is we decided to give 25 points to everybody who had been on the volunteer list. And we did that, I think, with a blanket award. Is it?
Yes.
Okay.
It was in 2020, and it was anybody that had received their 50 points the prior year.
Previous year.
Yes.
And good, I support that. I'm not criticizing it at all. Have you found that to make a difference with people like wanting to get more points? Is that like, I got 25, in the hole now, and now I only got to get 25 more? Has that helped?
That definitely helped for that year. I think people were struggling because people just cold turkey stopped having meetings and drills because we weren't allowed to go to the building.
Right.
So we were really behind on earning our points. The only thing you could get them is if you were running calls, and a lot of people weren't able to do that. So that year, that kind of saved a lot of people. This past year, I believe the process was 4 points per month for any members that had a doctor's note saying they were high risk and could not run calls, or if their employer wrote a note saying they couldn't run calls due to that because they would lose work. We maybe had 2 people use that. And that was only from January to June during the state of emergency.
Right.
And I think we had 2 members across the county that used those 4 points per month.
And
When I-
Commissioner Hewitt, just to clarify, the 25 points was just for the 1 year.
Right.
Okay.
Yes,
2020.
that was just
So
1
now
year.
that we're back with vaccines, we're back to the.
Yep, back
Okay.
to regular. Yep.
So when I first started into this job 7 years ago, the number that we were putting out for LoSAP was probably half of what it is now. I think I'm correct, Ms. Cudmore, you can.
The dollar investment.
The amount,
right.
yes.
Yeah, the amount that we put out. So the point is, it's jumped quite a bit in 7 years, which would lead someone to think it's going to jump higher in the years to come. So with that said, the people I've spoken to, I get my hair cut at Gatton's, and of course, we all talk about EMS fire, but they all do it for the love of wanting to do it. And the money they get, one guy said, hey, it pays my cable bill every month, So the point is, there's not a lot of money per individual, given that some of them put 30, 40, 50 years in. It's just amazing. But tell me this, if there was potential for abuse, where do you think it would exist? And if we needed, because again, we have to understand what we're dealing with is taxpayer money and accountability. So what we need to understand is if there's something we should be aware of, what should it be?
My perspective is that people don't join and volunteer fire EMS because of LoSAP, because most people who join have no idea that that exists. They are informed about it when they join. I can't really think of any ways that they would be trying to get this without, it's not super difficult. If you're an active member, you're going to earn your 50 points throughout the year. It's not super difficult. I honestly cannot tell you the
I
answer
think we
to
need
that.
an auditor,
To determine what the abuse would be.
if there is potential. Would they be able to find that out that you can't find? You're in the trenches almost,
Right.
quite often. If we hire somebody to come in from the outside and do a cursory look, is that gonna find the smoking gun?
I don't really think there is one, to be honest. It's pretty straightforward, and now that we have this program that everyone is using, everybody's adding their points in the exact right ways, and Firehouse Solutions does use the county code. They used that when they created the point system online for us.
Okay. Well, I know you've taken off work today, and I want to appreciate your, again, volunteer to come in here. But to the rest of my board members, obviously there could be additional questions, but I'd like to say that maybe we hold off on this SB thing and do a little bit more outreach into the community to find out if there is some kind of concern that we should have.
And that was a vote, the board took a vote to employ them, so I would just ask that we have a vote to not proceed or to revisit.
I would make a motion that we put a 180-day moratorium on moving forward with a contract.
I'll second that.
I have a first and second. All in favor, say aye.
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 Any opposed? Ayes have it. Thank you.
Okay. Thank you, appreciate that.
Thank you, Ms.
Anytime.
Turner.
You have my
Yes, sir.
numbers and email. Please feel free to reach out.
Before you go, this program is created locally?
I believe the Firehouse Solutions is a local company. The guys,
Should we be watching for them on Shark Tank?
I don't know. I think they're pretty well established, but I'm not sure.
This is pretty
Maybe.
cool.
And they, a quick look at their website shows that they do it in other states too, that they've, been selling their product to, firehouses in New Jersey and places like that, so.
Silicon Valley Lee.
And Paul, if you wouldn't mind just sending me the list of questions, and again, I'll add it to this material so we have a complete package. Okay, thank you so much, and thanks for your time
Thanks,
today.
and say hi to your
Thank
mom and
you.
dad.
Okay, that takes us to our presentation from Mr. Wing.
Do we have LoSAP? Oh, I'm sorry. I'm looking at something.
That was just our old business, so now we're on to
Now we're on to the regular.
Oh, okay.
presentation.
When's our actuary? Oh, new business, got it.
Yes, and thank you for moving around the traditional agenda. We did that for Paula's behalf, so thank
So
you.
that she could get back to work,
Yes,
certainly.
yeah, thank you.
Yeah, we did old business out of order, so to speak.
Got it.
Mr. Wing.
Thank you, Mr. Weiskopf, and good morning, everybody. Again, it's nice to see you all. We have a few items on the agenda today, as you can see, but I think we can move along, rather quickly with these. Some of these are old hat that we previously discussed, but we'll start where we always do with the fourth quarter performance report. So that's the top book in the packet that I had sent you, and if you would all please flip over the cover and then grab Exhibit 2 there and flip that over. And we'll start with the market environment, which is page number 9. And as you all know by now, we like to spend a good 4 or 5 minutes talking about the economy, capital markets, just to provide context for how and why the trust performed the way it did during the quarter. So again, we'll start on page 9, where you see U.S. economy up at the top left as the title of the exhibit itself. If you look at the top right chart, here at a high level, just showing U.S. real economic growth. The bars on that chart are the quarterly numbers. The striped bars to the right are economist estimates. And then the orange line is the year-over-year number. But if I can draw your attention to that first striped bar towards the right half of the chart, that was the estimate for Q4 economic growth. We note in the first bullet point that it was 5.8%. That data came out in late January. It actually came out quite a bit above economists' expectations at 6.9%. So a big reacceleration in economic growth from Q3. And the notable driver behind that was really inventory accumulation by private businesses. Actually accounted for more than 70% of that 6.9% growth was just private industries rebuilding their inventories, which had been reduced so dramatically amid the pandemic with supply chain issues. And when you think about the rest of 2022 and the other striped bars up in that top chart, you'll notice that after Q4, economists are expecting somewhat of a deceleration here in Q1, but then moderate growth as we head through the middle part of the year. And that inventory accumulation is expected to drive a lot of that economic growth moving forward. So we've seen some alleviation in the supply chain issues, some moderation, not nearly back to where we were or certainly need to be. But at the same time, if you look at the bottom chart, there is a long runway for businesses to continue to rebuild their inventories, to accumulate these inventories. And here we're just showing the retail industry as an example, and specifically that blue line shows their inventory to sales ratio there. And you can see the gray dotted line shows the average over the past 25 years or so at about 1.5. So in other words, businesses or retailers usually carry about 50% more in inventories relative to their sales. But all the way in the bottom right there, you can see the latest data print all the way down at 1.07. So again, just indicative of the fact that retailers and private industries across the board have been unable really to gain the inputs and the various inputs in their businesses to produce and gather these inventories to sell to consumers. So even though we had the big jump, there is still a lot of runway for them to continue to rebuild those inventories. But as I mentioned a second ago, certainly dependent on alleviations further in the supply chain issues that we've seen, which have driven a lot of the inflation that we've seen over the past 12 months. And keeping on that topic of inflation, if you want to switch gears and look at page 10, as I mentioned, a lot of the inflation that we've seen has been driven by the supply chain issues on the goods side of the economy, but we are seeing it broadening out, and specifically into the labor market that we talk about here on page 10. And we note in that first bullet point that the December employment report came in a little bit below expectations. That reverse course in January, we actually saw a pretty big number. But importantly, the unemployment rate has dipped pretty low, pretty fast. We know in that first bullet point in December, it was 3.9%. It was similar to that in January, but what's interesting is, as we note in the second bullet point, as I'm sure you've all well heard, the meme going around these days of the Great Resignation, right? A lot of private sector workforce quitting their jobs, looking for better opportunities, higher wages, or leaving the workforce altogether. And if you look at that top right chart on page 10, it's really interesting relationship between the unemployment rate there in green and this quits rate there in the darker line. They're a very strong relationship over time, but more recently, as you look to the right, they've diverged rather notably. And you see that quits rate is broadly consistent with an unemployment rate of almost around 1%. So the labor market right now is incredibly, incredibly tight, and we'd argue that this is one of the items that the Fed and the Federal Reserve has probably underestimated over the past 12 months, along with broader inflation. And these labor market concerns, or in other words, rising wages, which could feed into inflation in other parts of the economy, has really caused their pivot from a few quarters ago to really looking to aggressively tighten monetary policy.
Mr. Wing, let me
Yes, sir.
interrupt you for a second. Quick question.
Yes.
What we've always heard about the unemployment rate, there's always a group that have quit looking for a job. And somehow that group tends not to be, what's the term, counted.
Counted.
Yeah, it's like, they're no longer looking, I don't know what they live on, but they're no longer looking for a job. So with this tight unemployment rate, has that percentage of those people has that percentage gone way down? I mean, it seems like with the availability of so many jobs, and actually good paying jobs, that would lower the number of people who have quit looking for one.
You would expect that, Commissioner. We haven't seen that to a large degree. So what Commissioner Hewitt's referring to is essentially the labor force participation rate, which fell a couple percentage points amid the pandemic as people stayed at home, with child care issues, maybe health issues, not comfortable re-entering the workforce. We haven't seen much of an improvement in that more recently. The latest jobs report, it ticked up ever so slightly, but we're still below the pre-pandemic level. So historically, the type of evolution that you're describing very much did happen, right? That labor force participation rate tended to increase, and actually at the beginning part of an economic cycle, you usually saw the unemployment rate kind of continue to inch higher as more people entered into the workforce. But right now, those people that have left the workforce, we're not seeing them come back in droves for, again, maybe childcare issues still.
And let me expand on one other thing then. At least what I've read, is that a lot of people who are in the hospitality industry, maybe waitresses, waiters, people in the hospitality, working at 7-Elevens or things, convenience stores, when they were home, they may be taking a community college courses or something to improve their job skills and improve their ability to get a better job. And that sectors have been impacted more dramatically than other sectors, i.e., look, you go to a restaurant and the guy's always, I shouldn't say the guy, but it's typical to find entrepreneurs, restaurateurs, they can't stay open because they can't get help. Was that what we're seeing everywhere?
That's exactly what we're seeing. If you actually think about the wage gains that have become more prevalent over the past year or so, it's actually been those lower income cohort that have experienced the most wage gains, at least from a percentage perspective, because those industries have gotten hit extremely hard by the labor force participation, and companies are now having to raise wages pretty dramatically, and also offer other benefit improvements and things of that nature. So those industries, yes, have been hit the hardest, and now are getting hit the hardest with having to increase compensation for the workers that they're actually able to bring on.
Okay, thank you.
Which won't that have a snowball effect in that, let's say, McDonald's goes from 9 to, I don't know, let's say 15, all right? Somehow that's going to affect the price of the food that's served there, which in turn is going to impact the number of people who can afford to eat there, and on and on and on and on. We just haven't seen that part play out yet, have we?
Not to a great degree, but you're spot on. That's the logical progression, right? We've seen some inflation in prices of goods in the retail sector or the fast food industry, but that's largely been related to, at least this point, the costs of the goods going up. In other words, the, meat prices, things like that. However, as those companies continue to raise wages in order to run their business, then they're going to try, like most companies, to attempt to pass along some of that increase to consumers, is what we would expect to happen. And I think that's a good segue into a lot of the equity market volatility that we've seen, at least in 2022, is largely related or interrelated to these things. In other words, these wage pressures and broader inflationary pressures are becoming paramount to the extent that at the end of the year, which was just 6 weeks ago, the market and the Fed had intimated that they were going to raise rates maybe about 3 or 4 times this year. As of yesterday, after that big inflation print that we saw, now we're pushing 7 rate hikes this year, with the potential and the uncertainty around how the Fed's going to proceed, the impact of those rate increases to corporate profits, equity valuations, and the economy as a whole. As I mentioned, we're looking to head into a little bit of a slowdown here, and Fed policy has a lag to it of when it impacts the economy, but at the same time, it's pretty obvious that the Fed is beginning to tighten into that slowdown. So those combination of factors have really caused some investor angst here so far in the first 5 or 6 weeks, and has led to, equity markets, depending on the region, to be down, say, in the neighborhood of, 6 to 8%, whereas last year, as you all well know, we had gains, north of 25% in the U.S. equity market.
So are we starting to see any of the big mutual funds, or, for example, starting to cut back on sector involvement? Let's say I own a chain of hotels. So first I couldn't have any visitors because of COVID. And then the staff, I couldn't maintain the staff because I didn't have any visitors. And now that I can have visitors, the staff wants dramatically higher wages, so I have to increase the price of the room. All of this is out there. If I'm running a mutual fund, should I, or are you seeing the funds cut back in situations where the caboose hasn't caught up with the engine yet?
We are seeing that. So a lot of, essentially, what Mr. Walters is referring to would be, a REIT manager, owning and operating commercial real estate assets, but specifically in sort of those hardest hit segments within the market. So a lot of the managers have moved out of those segments and more into ones that have more secular tailwinds, say, data centers, industrials, those more related to infrastructure. But at the same time, those sectors or those companies, of the stocks of those companies, have really taken it on the chin. So now they're trading at a very, very steep discount to what they were trading at historically, but also a steeper discount to the rest of the real estate market as well. So to some extent, it's already been priced into those specific stocks. But to your point, before then, or before they really started to take it on the chin, we did see rotation of those managers sort of out of those areas, and again, into more areas that I mentioned that have allegedly more structural headwinds or no pandemic-related issues, or at least less pandemic-related issues.
Okay, thank you.
You're welcome. Okay, so with that said, if we could hop to page 12 now, just a couple of quick comments on asset class performance before we dive into the fund itself. We'll just focus on the chart to the right here, and the first 3 rows specifically, where the equity markets across the U.S., international, and emerging market equities. And at a high level, from a relative perspective, the theme was very consistent in Q3, or as it was in Q3. So you can see those green bars are the Q4 numbers. So strong return of U.S. equities, a little north of 9%. International developed equities just a shade under 3%, and then emerging markets, the laggards, that are about down 0.13%. So again, that relative performance remained consistent. However, from an absolute perspective, the numbers are much more favorable than what we saw in Q3, where U.S. and international equities were more or less flat or slightly in the red, and then emerging market equities were down about 8%. So just keep that in the back of your mind for when we get to the recommendation shortly. A lot of this relative performance, at least, actually, I'm getting ahead of myself. I'm thinking about the OPEB. I apologize. But when we get to the OPEB, keep that in the back of your mind later on. It'll drive some of the recommendation. But for the LOSAP, the other 2 key asset classes here under emerging market equities would be U.S. bonds. You could see Well, you can't see any green bar because you can see the return was basically zero for the quarter. And then high yield bonds up about 0.7%. So those two asset classes obviously also in the trust, and really the five above, including REITs all the way at the below, that were up north of 16%, all posting gains for the quarter outside of emerging market equities. So when we see the absolute return was much better than what we saw in the third quarter. So with that said, let me pause for a quick second before we dive into the numbers themselves to see if the board has any other questions or comments.
I haven't seen what we've done since January 1st. This is all through December 31st.
Yeah.
We've all known there's been a big, a lot of volatility. Let me use that term.
Oh, yes, that's good. That's a good term to say the least. So, Commissioner, in the second set of materials, we'll have a recommendation and an updated market value as of last week, so that'll become
Okay,
more
all right.
apparent
That's in here?
Yeah, in the other book.
in the other book.
When it goes to it.
Thought I read them both, but go ahead.
All right. So if you'd all please grab Exhibit 3 now and flip that over, and we'll go to page 19. Where's just a qualitative overview of some key metrics of the trust itself, and then we'll get into the quantitative information. But you'd see at the top of page 19, that first bullet point, we did end the year just a shade under $10 million at 9.7. There was an investment gain during Q4 of about $412,000, and then you can see the return there at 4.4% net of fees versus the policy index or benchmark at 4.5. So more or less in line with it. And just for some of the, the newer members of the board, the LOSAP is, relatively small from a dollar perspective. It is all passively invested to keep costs down. So in other words, when we talk about the difference between the return of the fund and the benchmark, there's not going to be much difference over time. The only difference, or at least as things stand right now, what's driving at least that slight underperformance, when you see the attribution bullets on the positive side, you see NA there because, again, we're all passively invested. But on the negative side is what we call U.S. equity structure, and we talked a little bit about this at the last meeting. So within U.S. equities, there's three managers. We got a large cap manager, mid-cap manager, small cap, again, all passive. So depending on the relative allocations between the three versus the benchmark, if there are slight deviations, then that can cause a little bit of a difference in the U.S. equity asset class. So what that's telling us, since it's on the negative side, is that since large caps did better during the quarter, then we had a little bit more money in mid caps and a little bit more money in small caps relative to that benchmark. And since they were a little bit behind, as you'll see in just a minute, the U.S. equity segment was a little bit behind, and that drove the slight underperformance for the fund itself.
Sorry.
On
Side conversation.
On page 20, we'll get into the data here, and we'll walk through this pretty quickly, again, just given the structure of the trust. But you can see at the top under the summary cash flows, again, on page 20, under fourth quarter, we began at about $9.3 million. See a slight net cash outflow there for fees and expenses, and then that net investment change of about $411,000. So all told, when you sum those two middle lines, the trust itself grew by about $400,000 during the quarter. Now, in the middle of the page, you'll note the returns on the sort of short, intermediate, and really since 2018, I'd classify that as intermediate as well. I'll cover these a little bit more detail here shortly when we look at the peer rankings page, so we'll get into those in just a minute. But then at the asset allocation versus the target, the last bottom table, you'll note that the current allocations versus the policy, there's not too much deviation there across the board. Again, this was as of the end of the quarter, and we'll revisit a more up-to-date look at things here in just a few minutes when we get to the recommendations in the other book. So on page 21, if you would, just to walk through quickly again what took place during the quarter from a rebalancing and execution perspective. So this table, think of it as a more granular table than the one on the previous page where we're just showing the total fund, whereas here we're showing all the investments to the left, their beginning market values, net cash flow, net investment change, and ending market values. So obviously those middle two columns plus the beginning is how you get to the ending, but I want to focus on the net cash flow. And again, to reiterate, all of the investments in the fund are ETFs, and when ETFs pay dividends, unlike a mutual fund, it's not reinvested. it's essentially thrown off into cash. So when you see negative numbers mostly across the board here, it's just these ETFs paying dividends throughout the quarter and then going into cash. Now, the action that did take place subsequent to our early December meeting was this second row, the first one in white there, where you see negative $41,000 and change. We did make a reduction of $40,000 from the mid-cap ETF as the market continued to ramp higher, really just taking some chips off the table there. And those funds were moved to, if you work your way down that middle column there, where you see the only positive number at plus about $62,000, money moving into the aggregate bond ETF, and also some money came out of cash to move into that aggregate bond ETF as well. And then the only other positive number there, really the money market fund above that last blue line of negative $11,000. Again, as those investments are throwing cash off during the quarter, that's where they go.
Does that column, is that column impacted by any outflow for beneficiaries?
No, and please, somebody else jump in, but there are no benefit payments being drawn from the trust right now.
So right now, we have no payouts to eligible persons.
Correct.
Not from the trust, correct?
Yeah, we're doing it out of general fund.
Right. Okay. Now, over time, the expectation, and I'm not going to scoop Jim here, but as the trust goes into a better funded ratio, after your funded ratio, that we would expect that to change. But for right now, that's not the case.
So that column is all internal
Yes.
to what we're
Yes,
seeing
sir.
here?
Right.
Okay, got it.
Okay. So if we could take a quick look at page 23 now, we'll look at the returns at a high level versus peers, and then we'll wrap up on the managers themselves. So again, just to reiterate, you've seen this page in the past. Again, we use a third-party platform to generate these reports, and really just gives us an opportunity to slice and dice the return data on an anonymized basis. Here, comparing it to public funds across the country. But the key takeaways are really down those bottom two lines in that bottom table where you see the circle and the triangle. So as you work your way from left to right there, you can see the 4.4 and 4.5% numbers I'd referenced for the quarter, and then in parentheticals are the relative rankings. So even though the 4.4 was slightly below the benchmark during the quarter, it actually did a little bit better than the median fund, which would be 50. So if the number's below 50, you're doing a little better than the median and vice versa. Now for fiscal year to date, obviously including Q3, a little bit behind that benchmark, a little behind the median. For the 1 year number, the calendar year number, a little bit of the opposite, a little bit ahead of that benchmark, but comfortably behind the median. And then the 3 year and the since 2018 you're well aware of. But, as the board has taken the approach of, being pretty conservative with the low amount of money and getting this off the ground, that's really driving those rankings, right? You can even see it from an asset allocation perspective. In other words, the bottom row in those rankings, that the conservative nature of the trust has driven those rankings at a time where markets, at least notwithstanding the past 5 or 6 weeks, have, more generally moved in a straight line upward. So again, just indicative of being a little bit more conservative here relative to, pretty much all the peers in the universe. Any questions about that data before we wrap up on the managers? Okay, so this is on page 26, and we can get through this rather quickly. So up top there, you see the total fund composite. So again, those are the returns that were referenced on the previous page. And then each of the other darker brown lines are the asset classes themselves. So the first one being the U.S. equity composite, or in other words, a weighted average of those 3 individual investments, which as you can see again are large cap ETF, mid cap, and small cap. But if you look at the U.S. equity composite return, just to illustrate the comments I made earlier, it came in at 9.4%, about 0.2 percentage points behind the benchmark. And if you look at the manager returns, again, you can see the large cap manager did the best there, nearly 10%, where mid cap's up 8%, and then small cap's up about 5.5%. So again, since we're using passive ETFs here, what's going to drive that difference is just having, more or less in certain areas relative to that benchmark. So having a little bit more in mid caps and small caps compared to the benchmark, since even though they made money but lagged the broader benchmark, that's what's driving that 0.2 percentage point difference between U.S. equity composite and that policy benchmark below. And then, as you know, on the rest of this page and the subsequent page, excuse me, This is all passive ETFs, so those returns are largely going to be in line with the respective benchmarks. So with that said, excuse me, let me pause here to see if there are any questions or comments around this. And I want to talk more about the specific lineup of investment vehicles here later on when we get into the discussion materials. But again, please let me pause.
We're staying within policy guidelines, right? Yeah.
Well within, Commissioner.
Yeah.
All right. Okay. So if we're ready to move on, then the next book you have is the discussion materials book, and per the agenda, we will kick it off with recommendations, which you will find behind Exhibit 1. So this is page 4. Where you see the fund allocations, again, page 4 in that second book. So to your question earlier, Commissioner, if you look in that second column under total assets, you'll see the value of the trust was $9.3 million as of February, the close of business on February 3rd, so about a little more than a week ago. So if we think about where things stood at the end of December at 9/7, the equity market weakness has shaved about $400,000 off the trust. So in other words, we're back to where we ended Q3, right? It's kind of wiped out that $400,000 gain that we saw in Q4. Now, importantly, as you know, when we take a look at these charts and try to be thoughtful about the recommendations, we always like to look at where things stand relative to policy. So that's the bottom left box underneath that big table where you see the asset classes listed in black, and then within the table, current allocations in black, targets in blue, and then to the right, the differences red indicative of an underweight and vice versa for green. So as you look up and down that difference column, not too much deviation from the current policy targets. A slight underweight to equities if you add up U.S. and developed non-U.S. at about 0.5 percentage point. A little bit of that overweight is in the REITs area, and then underweight to investment grade fixed income and high yield, which is largely coming from cash, right? So those ETFs throw off those dividends during the quarter, and it builds and builds and builds up the cash allocation. So the recommendation today, as outlined in that middle column under rebalancing, as you know, when that cash builds up, we come to the table usually with a recommendation of putting that to work. And even though equities are underweight to some degree right now, just given the environment, we think it'd be prudent, number one, just to move some of those cash funds into fixed income, where you can see $35,000 of that recommended going into the core aggregate bond ETF, so that's all investment grade, and then $15,000 going into the high yield ETF. And normally, we would usually draw cash down a little bit lower because it is refilled up over time, but I think having a little dry powder, if you will, isn't the worst idea in this sort of environment. So as we meet again in a couple months, admittedly, we don't know what's going to happen with markets, but, there is a decent possibility that, the volatility that we've seen may continue depending on what the Fed does. So I think it'd be prudent to hold a little bit more in cash than we normally would. And then you can see the impact all the way to the right there. Again, since we just have cash moving into fixed income, all the way to the right in that bottom table and the difference, you can see the investment grade and high yield essentially brought back up to target, all being sourced from cash, but again, leaving a little bit more funds in cash than we normally would. And then on page 5, as you know, just summarizing the recommendation or the proposed rebalancing on the previous page. So specifically, it would be to add $35,000 to the core U.S. bond ETF coming from cash, $15,000 to the high yield corporate bond ETF, again, coming from cash. So let me pause there. Happy to answer any questions or comments from the board.
My only comment would be I'm pleased to see that there are no private investments in the portfolio.
It's too small for that, Mr. Wallinger.
I think we're still trying to build this one up.
Yeah.
I'm going to make a recommendation. We move $35,000 from cash to iShare Core's U.S. aggregate bond ETF, and we move $15,000 from cash to iShares Bond USD High Yield Corp Bond ETFs.
I'll second the motion.
I have a first and second. All in favor, vote aye. Aye. Any opposed? Ayes have it. Thank you.
All right, thank you. So moving along here, the next section in the book is the investment policy statement review. So before I dive into this, as a quick background, again, with a new member here, just a higher level of the background. It's very similar to the process with the other county funds which we work with you all, asset allocation study, discussion of the current IPS and proposed new document. What we've also done based on discussions with the other fund is incorporate the edits that we agreed to there into these documents verbatim. So I know Ms. Quasny had reached out to the board, and it's my understanding there were no questions or comments, but that said, I still wanted to take a pause here to see if there are any questions or comments, because it wasn't really my intention to walk through the documents if there weren't any. But again, I did, when I paused here for a second, I did want to finish up talking about the timing of these statements and when we should think about how to execute them and line that up with the changes to the funds themselves, so we can do that thoughtfully. So with that, let me pause to see if there are any questions or comments as it relates to the IPS.
I will be interested to talk about the timing, but John, you've just come on. We've been looking at this policy investment statement for several meetings now. And the point of the matter is that we found that we were either obsolete, out of date, or whatever the term would have been. And a lot of what's happened here, at least in my opinion, is just an updating, bringing current, we have new people sitting in chairs now, yourself being one, David being another. And I really view this as a cleanup operation. And Catherine and Jeanette, you've been here as
Absolutely
long as
agree.
I have.
Totally agree.
Yeah, and I didn't see anything here that warrant me to say, wait a minute now.
Right.
But I would like to know about policy implementation, but that's my point. Anybody else has something?
I think we struggled with something similar over on the SORP side, did we not?
Yes, sir. Yes, sir. And the process was pretty much mimicked that. And as I mentioned, the thoughtful comments and suggestions that we reincorporated to the initial draft of that have been incorporated verbatim here as appropriate. As you know, the fund asset allocation is very different, but they've been incorporated into that draft column and then the clean document as well.
Glad we can contribute from the SORP side.
That's right. It's nice to have overlap. It's efficiency and scale. But to your question, Commissioner, around timing, coming here this morning, obviously I didn't know if there would be comments or questions or if we would have to go back and update anything. So based on my understanding, we're going to meet again in April. So I think it'd be more prudent to essentially, we can informally say we agree, but then formally execute it in April, where then we can go back and make specific recommendations to, so from a timing perspective, because the other key consideration, which I was going to mention later on, but I think is relevant now, for the investment vehicles themselves within the trust, as I mentioned, they're all ETFs, right? And as you know, we're going through the process of looking at a custodian for all three funds now. And when we move away from Schwab, who's the current custodian for this, and more to an institutional type firm, the rebalancing or executing those trades becomes more administratively opaque. And what I mean by that, now when the board approves something, we go on to Schwab, we can see the prices, we execute it per what the board has approved. When we go to a different bank, what happens is you submit letters of direction, right? So sometimes when you submit the letters, there could be a timing for when they get them to when they execute it. So it's not really happening in real time, which since ETFs trade daily, and it's like we talked about with the market volatility, the values of those ETFs can change dramatically throughout the day. So to combat or mitigate that risk, I think it'd be prudent to consider essentially changing the investment vehicles. So not the strategies, but many of these vehicles or ETFs have mutual fund equivalents, right? that don't trade throughout the day. They're just priced at the end of the day, and then the clarity and certainty about how things are going to be executed will be much more straightforward because there's no sort of middleman or timing issue.
Right.
So that will be a part of the rebalancing proposal, not only getting us more in line with the new IPS asset allocation, but also recommendations of how to, essentially, again, move out of this sort of predominant ETF approach to low-cost passive mutual funds that are doing the same thing, but will help alleviate some of the burden from an operational perspective, and again, mitigate some of those risks from an operational perspective.
Okay.
Passive as opposed to active management.
Yes, sir.
In looking over the document, just glancing, is there a segment in here about any prohibited investments?
Yes, sir. There's an attachment like we did with the SORP that's verbatim.
Oh, okay.
Yeah.
Must have missed that.
So all the changes, when I mentioned all the changes were verbatim as appropriate, I just meant that with the fund being, very different from an asset allocation perspective, some of the private market language wasn't relevant. So that isn't in here, but, things like track record, the prohibited investments, ADR language, and some of that other, technical language has all been incorporated.
All right, thank you.
You're welcome.
I like the red highlights, thank you.
You're welcome. You're welcome.
Absolutely.
Okay, so that'll be our marching orders going forward for April then, if that is amenable to the board?
Certainly.
Okay, great.
So you had mentioned.
Yes, sir.
We're right now with a broker-dealer, Schwab,
Yes, sir.
they're the custodian, moving to a bank, all right? So what's the mechanism for getting orders to the bank in a timely fashion so that we know we're getting end of those days pricing?
So how the banks operate is they have essentially cutoffs to take the direction so that they can input the trades. Now, depending on the bank, that's usually, say, around 2 p.m. Eastern time. So much like we operate with the SORP fund, instead of going on and executing things, it would be letters of direction. So drafting a letter with explicit instructions and then an authorized signer, which we prepare based on what the board has approved. In the SORP case, working with Ms. Pratt, and in this case, working with Ms. Cudmore to essentially throw it on county letterhead, sign it, and then submit it to the bank prior to that cutoff date. So that's the process.
But if we miss that cutoff date with them, we miss that day's pricing.
Correct. So we would get the subsequent day pricing, but when you're trading or essentially rebalancing, from a dollar perspective, you're still matching things up. So say, for instance, if we met on, a Friday morning, obviously you don't want to be presumptuous and assume that the board is going to approve what we propose, but essentially we would draft a letter, say, over the weekend or first thing Monday, get them to Ms. Cudmore, and it would be executed Monday, close of business. That would be the general schedule, I'd say.
Well, would not staying with a broker-dealer, regardless of who they are, give us another 2 hours on the trading day?
It would give another 2 hours, yes. Now, there are other aspects, and I'm only talking about the rebalancing here about, the relative merits of staying with a brokerage firm like Schwab versus an institutional bank, one being client service, which I honestly could speak to for hours, and I'm sure some others on the board can as well, and not really having a dedicated team, calling an 800 number, sitting on the phone for hours, trying to get documents and things of that nature, which are very cumbersome from an administrative perspective. So I see those weaknesses far offset the change in the execution of any proposed rebalancing if we had to wait an extra day.
Okay, thank you.
You're welcome, sir.
Thank you.
Okay. So one more item for us, and this will be very quick. If you would please grab Exhibit 3, flip that over. As you know, just like to give you all a heads up on what's coming down the pike here. So this is page number 8. So again, in the next meeting, we should have some decent updates on that custody of RFP for the board. Just to give you a heads up, we have 2 firms shortlisted. Interviews will be happening within the next 2 weeks, but we're still largely on track, as previously discussed, to hopefully award that mandate and have that transition take place before the end of the first half of the year or before the second quarter. So that's moving along nicely there. As far as the next meeting, so we'll do that. We'll do the recommendations as we just discussed, and then subsequent meetings largely follow suit with those items until the custody RFP is done. And then again, like we talked about earlier last year, to the extent the board wants to discuss the relative merits of, the traditional consulting which we provide versus OCIO, we're happy to do that. But again, we still have, we would argue more pressing, more important work to do to get to where we need to be before we even revisit that. But that's largely
Agree with you. That's not on my top list.
ours neither. But, I know it was something that the board talked about. And if you want to just talk about the relative merits, great. If not, it's fine too. We're happy to cross it right off the list.
In changing custodians,
Yes,
do
sir.
you right now foresee any bumps in the road as might have been experienced or is being experienced with other change of custodians?
Not with this fund particularly, because there are no, as we talked about earlier, benefit payments being made. That's the biggest risk, I'd argue, with changing a bank. If you have monthly benefit payments going out, obviously, the last thing you want to do is have an interruption in those benefit payments. So for this fund specifically, and even in the OPEB, no, it's just getting the assets transferred. One of the bigger things for a couple of the other funds are changing wire instructions, things of that nature. But the fact that there are no benefit payments being made from this fund or the OPEB, it should be a much easier process. Admittedly, it's getting somebody on the phone at the current provider and working through their documents and making sure they are working to get the process done. But we've done this many times in the past. And again, since there are no benefit payments, I don't foresee it as much of a risk. It'll just be more undertaking around getting the wire instructions changed.
Okay, thank you.
You're welcome, sir.
Thank you.
You're welcome. So that wraps up my comments for this meeting. Appreciate your time, and I will step back.
Appreciate it, thank you. Next would be committee reports by Ms. Quasny.
I think we need an acceptance of the Q4 investment performance. We didn't do a vote on that. Q investment report.
So motion to accept the.
I'll move to accept the investment reports for Mr. Wing's
Quarter four.
report.
Quarter four.
I'll second that.
We have a first and second, all in favor, please?
Aye.
Aye. Ayes have it, motion carries.
Thank you, Michelle.
Thank you, Michelle. Next is the committee report by Ms. Quasny.
Thank you. So since our last meeting in December, the fund has made 2 payments. One payment to Bolton Partners for the GASB report, $5,374, and one payment to Marquette Associates for the investment consulting of $2,075.64. Currently, we have approved dates for the calendar year 2022 as April 29th, June 24th, August 26th, October 8th, and December 2nd.
Did I mishear you? The October date was,
28.
October 28th. I'm sorry, did I not say that?
I didn't hear that.
Oh, okay.
That doesn't mean
October
anything.
28th, yes.
28th.
Yes, sir.
Okay.
Thank you.
Thank you. And that would bring us to new business.
We have to accept that.
I'm
Yeah.
sorry, we always have to accept these.
Yes. I move to approve the plan administrator's report.
Second.
We have a first and a second, all in favor?
Aye.
Ayes have it, motion carries. Now we are on to new business, starting with Bolton Partners, the LoSAP valuation as of June 30th, 2021.
Water.
Thank you.
Thank you.
I don't know if I should be offended if people walk out when the actuary comes up.
It's a sign of trust.
Yeah, right. Do you want me to start or you want me to wait?
You can get started.
Okay. There you go. So we've just completed the valuation as of June 30th, 2021, which determines the recommended contribution for fiscal years ending 23 and 24. My name's Jim Ritchie. I'm with Bolton Partners. I've been with Bolton Partners for the last 3.5 years. I actually run our retirement practice, and I've been involved with St. Mary's since I've been at Bolton. And I think St. Mary's has been a client of ours for a very long time. So I'm going to hit some of these meaningful highlights, and if you have any other questions in between, please feel free to stop and ask me. So I'm going to start on page 2 with the actual determined contribution. It's been pretty steady, kind of the last 3 valuations. We had a little bit of an uptick from the last valuation, from a little under 2.5 million to a little under 2.7 million. Increase is kind of twofold. One is there was an increase, I think was we mentioned earlier, on the number of retirees that got credits. But more so, you've been making contributions that have been slightly less than our recommendation, and when that happens, that difference sort of gets re-amortized into our future contributions, and that's probably more the driver of the increase. And that was offset somewhat by we had pretty good asset returns, but the assets
Why would 21-22 drop by about, what, 100,000? Is that market performance?
Yeah, it's a mix of market performance and whatever the data demographics were can contribute to both of those. You know, as you talked about trying to do credits, LoSAP plans, the data, and you're no different, is very volatile up and down. And the challenge is because these people don't get paid, they're not in payroll systems, and then you're trying to have a separate system to monitor credits. It tends to be the credits that come in and out each year tend to be pretty volatile. And then looking at the liability kind of progressing as we would expect. The liability goes up each year with what's called the normal cost. The normal cost represents the accruals or the credits that were given for a year of service for everybody for a particular year. And then it goes up with interest, and then the liability reduced by any benefit payments that were made. So you would expect it to go up. The normal cost is between $500,000 and $600,000 a year. So for the 2 years, you would expect about $1 million in normal cost increase. And then at 6% interest, that's about 1.4 million per year in interest, and then offset by a little over $1 million a year in benefit payments. Kind of moving to page 3, the only highlight I want to make here is changes in assumptions and methods. We made 2 assumption changes. One I was a little hesitant about, but we ended up going forward with. First, I think since we'd had last done our valuation, the Society of Actuaries had published some public sector mortality tables. So we moved you what was called the RP 2014 table, which was more generic based on corporate pension plans to public sector safety mortality, which is more indicative of police and fire mortality. Just thought it was more appropriate, and since it had come out. And then we used the most recent projection scale with that. And just a quick education on projection scales. What we assume with the projection scales, we have a mortality table. It's based on a certain period of when that mortality happened. And then we assume it's going to improve over time. So that's what our projection scale does. So a 65-year-old today might have a 1.5% probability of death, but we think in 10 years that a 65-year-old in 10 years would have 1.25% probability of death. So we assume it improves over time, and that's what the projection scale does. The other one that was a little more, I was hesitant to make, but went forward with, up through April 2021, future inflation indication was more in the 2.1% range. We were at 2.75, so we were quite a bit high. As well, in the OPEB plan, we assume 2.5% inflation. So we did decide to still come down despite the recent increase in inflation. And our inflation assumption for a pension plan like this goes over our 20, 30-year period, because that's how long we're paying benefits out. So we don't try not to give too much weight to a short period of time. We probably would have come down to 2.25 had it not been for the recent inflation increase. So we went to 2.5, plus we wanted to be consistent with the OPEB plan. We do a lot of audits ourselves, and it's kind of hard for one firm to justify 2.5 in one report and 2.75 in another, so we also tried to merge those. On top of that, we made it a refinement to the cost of living increase assumption. So the cost of living increase assumption is CPI, but it has a cap at 3%. So if you have a long-term assumption of 2.5% of CPI, it's not going to really flow that it's going to be 2.5% every year. Some years it'll go up, some years it'll be down, and it'll average out to 2.5. So even though your long-term assumption is 2.5, a 3% cap will have an impact. on what the COLA, the cost of living increase is. So we went back and looked at 30 and 40 years of inflation, added a 3% cap to that to see how much it reduced the overall impact of what a COLA would be. And we were between kind of 15 and 25 basis points. So we were a little conservative and dropped our assumed COLA increase by 15 basis points below what CPI was to reflect the impact of the cap. Any questions on that?
So I know you're taking a long-term view, but if we look at inflation today, which has been relatively compressed time-wise, doesn't it take kind of a longer period of time to work that bulge to work its way out of your assumptions? I mean, this spike that we're in right now, why doesn't that have kind of a trashing effect on your assumptions going out, let's say, for another 5 or 7 years till things sort of get back into equilibrium?
Yeah, what we want to see is what happens in the next 5 years. So, there's two schools of thought on the inflation I think that Pat talked about. The one is, this is supply chain, so it's temporary, and it may self-correct in the future, so you may even see a deflationary period if that's the case. The other school of thought, is it may be here to stay a little more. We've certainly seen a lot of wage inflation on top of that. We sort of reverted back to what the Congressional Budget Office uses for their long-term projections, as well as the Office of the Actuary with Social Security. The Congressional Budget Office, though they came out in July, so it was the beginning of the inflation, they're still at 2.1% on their long-term inflation, and Social Security's at 2.4%. So we'll have to see. I mean, you're talking about 7% is one of 30, 40 years we're looking at. So it'll have a spike, but not a big spike yet. So I'd like to see what happens over the next 5 years before we give it too much weight.
Okay, thank you.
So we're going to skip all the way to page 7. Again, you see the actuarial liability went from 21.3 million to 23.6 million. The normal cost jumped quite a bit from 500 to 600,000, which is about a 20% jump. A large part of that was we had a decrease in the number of actives getting credits, but we had an increase in the number of retirees. Older people have a bigger impact on the liability because they're closer to their payment age. So when you have, it could take an increase in one retiree would be equivalent maybe to the increase of 3 or 4 actives from a cost perspective, just because retirees, those in pay status, those that are older, have a larger liability because they're right at the payment date. Whereas somebody younger who's maybe 25 picking up a credit, we're not assuming they're going to get that payment for another, 30, 40 years. Right. And then since our last valuation, the assets have gone up about $3 million, and I think they're up another $3 million as of today per Pat's report. So the plan's getting closer to about 40% funded if you look where the assets are today.
So, excuse me, back on page 2 then, let me see, page 2. That bottom row, plan funded ratio from 14.4 to 25.7, that denotes pretty good progress at being on track for being correctly funded. Is that correct?
Yeah, that's correct.
And you're saying the new number, if we were to see it now, would be?
About 40%.
About 40.
Yep.
Thank you.
Mm-hmm.
And for, John, our goal in that is we've had some relatively good years in fund balance. And the commissioners have made decisions to put a little bit more into this than we have in the past. So while we've been successful in getting their OPEB up to this number we're after, this one has lagged behind. But this one was relatively new. This is about 8 years old versus
Correct.
the other one was older than that. Bottom line, I guess I'm driving at is that we're getting there, and we're trying to understand going forward how much we need to put in. Now, I think I won't speak for other commissioners, I can't. But I will say, I think there's a proclivity to want to get this done because we're close. It's not like trying to go to 100 million. 23 is still a big number, or 17, that's still a big number. But being at 9 makes it a lot more easier to fund at a higher level because we're closer to our goal.
Got it.
But I think what you'll see is while we're at 40, I thought we were at 50 a while back, but, you know, that's a question for after you're done, sir.
Okay.
We'll talk about that later.
And that actual increase has come from what we appropriated in the FY '22 budget, the
Right.
additional $3 million.
So just looking on page 7, you know, our, what we call the ADC, the actuarially determined contribution, the pieces of that, the biggest piece is what we call the amortization of the unfunded liability. So we had a liability when we started, we've been funding it. Our initial plan was to fund that over a 20-year period, starting 8 years ago. So we're 8 years into our 20-year period with 12 left. So that 1.9 million is to fund that almost 18 million unfunded liability at a 6% interest rate. We have 12 years left, and then we have gains and losses that come in that I'll talk about on the next page. But essentially, that 1.9 gets you fully funded in a 12 to 14-year period. The normal cost represents each credit, so you want to at least contribute the normal cost, otherwise you'd really be falling behind. On top of contributing the normal cost, you'd also want to cover the interest on the unfunded, because otherwise your unfunded keeps growing if you don't at least cover the interest. You know, it's like having a mortgage and you don't pay the interest. Then your balance is going to go up, not down. So our recommended cost, as we said, was 2.5 million. And then we just give that interest for a year because we determined that at the beginning of the year, and up to a little under 2.7 million is our recommendation. Looking at page 8, you can see all the pieces of the unfunded. We originally funded this over 20 years. We're 8 years in, so we have 13 million left on that original payment. And then each year we calculate whether we have gains or losses, and whether we make any change in assumptions. You know, the ultimate goal is those gains and losses kind of wash each other out over the years. Some years you have gains, some years you have losses. We've had a little more losses than gains, and part of that is you haven't quite made up to our recommended amount, so that just rolls back into a loss. And then that bigger loss a few years ago, that 2.5 million, that was a combination of, I think we were recommending 2, you were making about 1, so that kind of accumulated, as well as that year we had a big increase in counts. I won't spend too much on 9 and 10. 9 just shows a reconciliation of the assets over the last 2 years. I mean, the good news is you have a positive cash flow. You've had 2.1 million in contributions coming in, and about 1.1 million in benefits payment going out. So you've had about $1 million per year of net positive cash flow. Participant summary we look at the data from 1/1/19 to 1/1/21. The number of actives did decrease from 953 to 906, but if you look down at service retirements, those have gone up from 280 to 308. And then the next few pages just provide some reconciliation of the data. Then we have plan provisions and then assumptions. And that's my report. Any additional questions?
Okay. Tell me. Well, first thing is I know you talked about volatility in the market versus the dating, the timing of what we're doing. When I see this being June 30, 2021, I'm saying this is old news, especially given what we're dealing with now. So would let's say Bolton Partners has had a big influence on the amount of money that this county puts towards whether it be OPEB or LoSAP. And what this commissioner has tended to see over the last 7 years is that I'll call it the UAAL, the unfunded actuarial accumulated liability, it continues to go up. And that is predicated, I'm assuming, on the number of people coming in, or the new members. Is that true? What makes that liability go up?
So the liability itself is it depends if you have what we call immature or mature plan. So an immature plan would have more actives than retirees. And
would this be an immature plan?
You're sort of in the middle. You're kind of getting closer to because you have a lot of retiree liability, so you're getting a little more mature, but you haven't funded it. So the liability goes up with interest every year. So it's going to go up 6% plus the normal cost. I think a couple of years early, while you were making good progress towards it, you were contributing, I think we have that on page 22. The 16, 17, the 1.5 million, 16, 17, and 18, that was probably covering the normal cost and just really probably just getting the interest. So you were just covering your interest costs. You weren't really making an amortization payment, if you will, towards the unfunded liability. So it's going to kind of stay flat from that perspective. And because you're not really paying it down, so to say.
I guess where I'm going with this is what we're seeing is a shift from volunteers or people who would be eligible for LoSAP
Right.
to a career force that's going to be subject to our retirement, our OPEB side.
Right.
Because now they're going to become county employees versus volunteers before. So I see this kind of, I use the term lowering of impact on LoSAP and an increasing of impact on OPEB.
Right.
And my goal is to understand how much, as a commissioner, we're coming, I use this term, when times are good, anybody can run a business.
Right.
When times are tough, it really weeds out the good and the bad. And as a person who was in business for 38 years, I had my good and my bad. So my point is this. Right now, we're having good returns. What's happening in this county is we have a Navy base that continues to hire people at great salaries. We have contractor force that continues to hire people at great salaries. We continue to get 3% or whatever our piggyback amount is of that money. So we're continuing to see increases in revenue. And with that said, these types of things, this retirement is very important that we fund it to a point, but that we don't overfund it. Because I use this term generational disparity. When you talk about a 20-year amortization, and we're either forward funding it in certain years like we did with OPEB, we end up with a situation where people who are matriculating out of the workforce, people in their 50s, late 50s, 60s, that matriculate out, they take the burden off of people who are coming into the workforce at 20, 25, 30 years old. So it's not fair. It's not fair to the people who are paying extra on their way out versus letting off the people who would pay 20 years out or 18 or 19 years out. So again, I'm sorry to bring that up, but my point is I want to make sure that we're putting the dollars in the right place. And Bolton Partners has a big impact on those decisions. I saw it in OPEB, and a person sat in your chair there, Mr. Biner, interesting gentleman, nice guy, I like him. But I worry that you guys have too much impact on our budgeting, and that your information is a little bit dated by being June 30th, and we're trying to make a decision after it's gone from 6 million to 9 million. So it's not a criticism, sir. I'm sorry if I said
No, that's fine. Oh, I understand. So, it's just challenging for us to, this one's moving up quickly because you're putting so much money in and you just started funding it. So there's sort of a progression for it, and we're always trying to do these in a point where, we give you enough time to put something in the budget. But long-term, the liabilities, you can see from year to year, it tends to grow in the pattern that we think, so that's not going to change so much. So the contributions, the reason you're at 9 million from 6 is largely because of cash flows that went in, that were part of the contribution. So, we could do this valuation every year, we do this valuation every other year, you could do it every year. I don't know that it's going to change the recommendation. What we have and what benefits we're funding have already been earned by people, so this has to be paid out, so that's not going to go down. If you will.
But I just wonder sometimes if the number of people is going to go down. Now, OPEB,
But even if the number of people go down, that'll change what we call the normal cost number,
Yes.
which is the 500,000.
Yes.
But it won't change the unfunded, because that's already been promised.
okay.
Right.
To the retirees, the current
And the
retirees.
number of retirees is
benefits.
increasing.
Look, sometimes I don't get it all, okay?
Right.
No, that's fine.
But I do read this, and I do try, I got Google like everybody else, and
Yep.
I tried to research it. So I said OPEB, but I didn't mean OPEB. I meant COVID. COVID has really followed up a lot of things, and it's been
Yeah.
my impression that it has lowered the average lifespan. Is that true or not?
So that's been published, and I actually work on a committee with the American Academies of Actuaries, where what we said is what they've published was what they've assumed with that life expectancy and the impact of COVID is they assume the death increases in the last 2 years will continue forever. So meaning we will be in a pandemic forever. That's what they do when they publish these lower life expectancies. So yes, there's been more deaths the past 2 years, and it's lowered life expectancy, but it's been minuscule.
And it's not going to have a dramatic effect.
No. Mm-mm. Because we'll come out of the pandemic and then it'll renormalize itself. So if you look at deaths in the U.S. from 15 to 19, deaths in the U.S. averaged about 2.8 million a year, 2.7, 2.8 in all those 4 years. In the last 2 years, deaths have been about 3.2, 3.3 million per year. So it's gone up quite a bit. And then when they say life expectancy's gone down, they take that and they assume that those extra 500,000 deaths in the U.S. per year will continue forever.
Okay. So it's a new trend. So the last thing, and I'm sorry that you won't be here for OPEB, but I will ask you this.
I will be here for a bit, by the way.
Oh, yes.
Yeah, I'm filling in for Kevin.
Just for you.
Poor thing.
Yeah.
Then I'll wait until next time.
Okay, well, you can ask me now. But that's fine.
Well, you can think about it between now and then. What we try to do is control inflationary cost of retirees, all right? OPEB, all right? So the other thing is providing services at a rate that our constituents feel that they're getting the services they're paying for with their taxes, okay? So what you got to do is you got to counterbalance the workforce. The number of people you hire, the number of people who, again, I use the term matriculate, but people who matriculate out of the workforce. And you bring in new people, and you bring in younger people for the older people, you bring in smaller salaries for the larger salaries. So what I try and get my head around is how do we control this OPEB amount? How do we keep it? I'll give you an example. The Board of Education has $497 million liability on their OPEB. Last year, they increased their OPEB by $78 million, and they put $2 million down on it. They're so far in the hole, they'll never get out. But that's been the case with the state of Maryland, Anne Arundel County, Baltimore, Baltimore City, Montgomery County. These are sophisticated people who are smart. They have a lot of wealth. And we're not, look, I'm a country boy, and I know it. I'm not as smart as those guys. But why have we funded ours to this amount, this 100%, and it hasn't impacted our bond ratings, hasn't impacted their bond ratings? Ours hadn't gone up because of it. Theirs haven't gone down because of their liability. But how do we correct it? How do we finally say, Bolton, you're going to tell us, or Gaspee, you're going to tell us, this is going to impact your balance sheet. Therefore, you need to be worried about that, or you need to be concerned about that. And it makes no effect. Why is that?
Yeah, OPEB's pretty volatile, and I think we've been sort of pushing our recent position is probably not to fund an OPEB to 100%, because
That's a switch.
Yeah, because it does tend, and I think we even have numbers in our latest OPEB report that
Shift that paradigm.
Well, the last actuarial that was completed, we updated it to be 80% funded.
80, right?
yeah.
I do remember that, but I've
That's-
always thought you guys were pushing us to 100.
Well, that's sort of the I would say that's an actuarial best practice or an actuarial standard, but OPEB is so much more volatile than a pension. That can go up, it can go down. People come in and out, laws change, you can cut back benefits, you can deduct deductibles, all the changes you can make. We are seeing, to your point, I have another client where their OPEB went up to like 125% funded. It's like, they don't really need to be funded to that level. So we are starting to look at that issue and back down to maybe 80% is the right target.
Right, and we're one of them people also. We
Yes,
exceeded
we
our
are.
liability, so we now have an asset and not a liability on our June 30, 2021
Right.
financials.
But you just raised the specter that for people who have OPEB accounts, they're chasing and will be forever chasing a moving number.
Yes,
And
that's
you've
my-
already talked about some serious political entities like the Maryland Teachers Association. They'll never get there. They'll never invest their way out of where they are now. So why wouldn't the recommendation be, folks, you need to convert this to something else where you can get a handle on what it's going to cost you down the road?
And let me just chime in on it. That's your question to answer, but my chiming in on that is to say, I believe they're going to dumb it down. At some point in time, someone's going to say, this just isn't reasonable. We just can't make this number, we just can't make up this deficit. I think I read recently Baltimore County or city was down 1.1 billion. You're not going to make that up, even if you put it on a 30-year amortization. You'll just have to take so much from services to try to round up that money to put towards that liability. So it just seems like while we had this GASB 45 that started all this stuff back in 2008, that we need to come out, when I know we've had, 65, 75, 78. We keep getting this General Accounting Standards Board thing of like, look, you guys, it's going on a liability on your balance sheet. You better worry about that because Moody's is going to whack you. And that's not happening. I'm losing faith in those guys. So anyway, that was a long expression.
Yeah, but you bring up a good point. So in the corporate world, the trend, well, a lot of corporations just got rid of retiree medical. It's gone, which will have its own implications on society and the government and the taxpayers ultimately, right? Because people don't have medical, that somebody's gonna pay something somewhere. And a lot of times the government might come in or Medicare might pick up more. We saw Medicare D under Bush, that added a lot of cost to cover medical. But another trend that's been there with larger corporations is doing something more like a defined contribution approach on the medical side, on the OPEB side, retiree medical. So you can set up like a kind of an HRA or a type account for retirees where you just have a pre-taxed amount of funds. So it gives you a fixed budget. You put that money into you give each people accounts, and then they have that to spend over their lifetime.
Well, if they had been working off an OPEB, does that money get converted into what you're talking about now?
It depends on what your clauses are for how much ability you have written into your own laws or not to cut benefits. But you could convert people to that. Sure, you could cut back the benefits you're offering and put it into something.
We've had a little bit of trouble getting in that direction, in my opinion. We still have 8515 health benefits for our employees. And look, I love our employees. It's great. But as someone who was in private business, I couldn't afford 8515. And even the Board of Education's gone to 80/20. The Calvert County is 70/30. Some are going 65/35, but St. Mary's remains at 85/15. But there's no political will to
But even at that, you look how those costs are going up.
Mr. Weisskopf's going to come in.
Oh, I was just going to say, but you always have to be wary of comparing apples and oranges, right? Maybe somebody has 85/15, another county has 70/30, but what are their salaries? What are their other benefits? You just can't pluck out one
Look at
thing
the
in a
entire
vacuum.
package.
All right.
know.
You got these guys always. He's a county attorney, by the way. so.
Yeah, but on the other
I'm
hand,
sorry, dude.
on the other hand,
It's fine.
just focusing on this issue, the real issue is, can we ever get to the point that we can pay what we're supposed to be, what we're promising today to pay out?
Sure. There's lots of places, California has many towns and cities that are declaring bankruptcy, right? Oh, absolutely.
Yeah, I agree. But I would say to you, John, we've got there.
Yeah, we're there.
You know,
We've exceeded it.
This country bumpkin, I shouldn't say, the people in this county have taken that seriously, have taken Bolton seriously.
Absolutely.
And I think what we've been able to ride, look, we've doubled our OPEB fund in 6 years. And I'm not sitting here to say I'm responsible, I'm not. But I'm proud that the county has been able to do that.
Took it
But we've
serious.
also been on the cusp of a market that's just, taken off. The end of the Obama and that last guy we had, we had great markets. I sometimes worry they're oversold. And a big correction will, so we've done a paradigm shift of having these higher returns and going to a lower return. Well, where we used to be the number one, number three performer and the former asset strategies manager, we're now down in the 90, of top 100. But our volatility, our exposure is a lot lower. I use the term, we're walking away from the crap table. We've got our money, and the longer you hang around in this biggest casino in the world called the stock market, the more exposure you have to losing it. So, anyway, we're getting way overdue. I'm sorry.
Oh, no
Mr.
problem.
Chairman.
Yeah, but just as a follow-up, and we can discuss more at the OPEB meeting, but we do have a health practice, so health design is sort of out of my area of expertise. I have more value than design, but we do have a health consulting practice that can help you design or look at your retiree medical programs and kind of give you some of the latest thinking in the private sector and in the public sector. That's helpful. Better ways to contain the cost going forward.
Well, thank you very much.
Sure, thank you.
Even though I pick on you guys, I like you.
Okay, I appreciate that. You can tell me you like me better than Kevin. I won't be offended.
I don't know you that well yet.
I'd like to make a motion to accept the LoSAP valuation as presented.
I will second that.
We have a first and a second. All in favor? Aye. Ayes have it. Motion carries. The next item of new business would be 2 certificates of appreciation. The first to Mary Ann Murray, who could not be here today, but we appreciate her many years of hard work and dedication to this board, and we thank her for that, and we will put it in the mail. And the next is, I guess we're front-loading Mr. Walters and giving
Well, in
him,
the spirit of the Olympics, this is like getting my gold before I
Right,
even took to the slope, so.
but we will want it back if we don't see you again. But based on how much you do for the other boards, we are certain that you will stick around, and we sincerely appreciate it and look forward to working with you on this one.
Yeah, and John, as my name's on this thing. John Walters, this certificate of appreciation is presented to you for your service to the Length of Service Awards program. Your diligence, dedication, a relentless pursuit of excellence has earned the community's gratitude, respect, and admiration. We thank you for your commitment to the betterment of St. Mary's County and its citizens. This date, February 8th, 2022, signed the Commissioner of St. Mary's County.
Thank you, Commissioner. Certainly. Let me just say, I'm glad I had a lot of questions to ask.
That's right. Well, thank you. And next would be a motion to adjourn.
Sir. I'll make a motion to adjourn.
I'll second.
All in favor, say aye.
Aye.
Ayes have it. Meeting adjourned. Thank you.
Thank you.